What I love about being a passive investor, you can invest in different markets. You can invest in different asset classes. You can invest in different operators. You can invest in different niches. I want multifamily here. I want self-storage here. If you're starting early on, I would focus on one niche. Listen, I would focus on multifamily, to be honest. That's just my passion, my love. But if you like RV parks or you've had some experience with them, focus on RV parks for your first 1 or 2 passive investments.
Welcome to the Physicians and Properties Podcast, the show where we teach you how investing in real estate can give you the freedom to practice medicine and live life how you want.
Doctor!
Now, here's your host, Dr. Alex Schloe.
Hello, everyone. Dr. Alex Schloe here with another episode of the Physicians and Properties. Today's podcast guest needs no introduction, but I'm going to do my best to give him one. Gino Barbaro is on the podcast. You might be familiar with Jake, and Gino is the Gino half of the Jake and Gino. He is an amazing entrepreneur who has grown his real estate portfolio to over 2,200 multifamily. They've transacted over $350 million in assets, and Gino and Jake teach others how to do the same through the Jake and Gino premier multifamily real estate investing community and education. To date, their students have closed over 76,000 and have $5 billion in deal volume. Gino is also a best-selling author, a husband, and a father to 6 children residing in St. Augustine. This podcast episode was amazing. We talk about Gino's start working in a pizzeria that he owned and how that led to him meeting his partner, what you should look for in a partner, and then just the absolutely amazing real estate journey that he's had. We talk a lot about the importance of education and community, so be sure to listen because it is really important. Who you surround yourself with can completely change your life. If you're interested in learning more about how to evaluate different deals, how to vet a syndicator, how to figure out how to walk through the process to vet a sponsor, align the interest with a sponsorship group, and analyze deals, Jake and Gino have created the Passive Investor Pro that they would like to offer to our community as well. Passive investing is a fantastic opportunity for physicians. If you're interested in joining Jake and Gino's Passive Investor Pro and learning how to vet and analyze offerings and different syndication opportunities with the coaching and systems in order to help you do that well, then click the link in the show notes and join the Passive Investor Pro. Without any further ado, let's get started with today's episode with the amazing Gino. Welcome to the Physicians and Properties Podcast. You're not a physician, but I'm so excited to have you on the podcast today. Someone I really look up to, both you and Jake, and so glad to have you on the podcast. Thanks for taking the time to talk with me all the way from Florida. We just recently had our second kiddo, 3-week-old, so a little bit tired, but things are going well. It's very blessed. Got 2 healthy boys. My wife's outnumbered, but it's been a good time. A lot of people listening to this probably already know who you are. You guys have been doing really big things in the multifamily space, in the commercial space, as well as education as well. So thanks for doing that. But do you mind telling folks a little bit more about yourself?
Well, let's start from where I started from. I was not a physician. I did go to college. I got out of college, and after a year working in corporate, I really just couldn't take it. I just went to college just to please my parents, I think. And I like college. I really enjoyed to learn. But what I wanted to do is I wanted to build a business. And my father owned a restaurant. That's why we call ourselves the pizza guy. I'm the pizza guy. I owned the restaurant for years. And Jake was the drug rep. He was actually working for Glaxo at the time when I met him at my restaurant. He was going out and he was taking orders from my restaurant, going to the doctor's offices and trying to sell pharmaceuticals. And listen, I loved the small business aspect of it. I really loved craving that culture. I loved the identity of having the small business being, I would say, a staple in the community. Everyone knew Gino's Trattoria in my community. I really was proud of that. That was my identity. As I think a lot of doctors get into medicine because that becomes their identity. They're happy, they're proud of what they do. But at some point, for me in 2007, everything came to a crash. My father passed away. I felt as if I was living his dream and I wasn't making any money. I was working a lot harder. And I'm saying to myself, am I in the right business? I picked up a book called The Secrets of the Millionaire Mind by 𝐻𝐻𝐸𝐻, and everything for me from then on just completely changed because I was blaming everybody. I was blaming the economy. I was blaming Bush. I was blaming Obama. But I said to myself, hold on a second. I'm 38 years old at the time. All of the results that I've had up to this point are of all the actions that I've taken. And 𝐻𝐻𝐸𝐻 is right. Your fruits are in your roots. I didn't have that many fruits because my roots were weak. My roots were shallow. And when I decided to take responsibility and to really plant my flag and to really learn how to invest in multifamily, that's what I chose. I had made a couple of mistakes in real estate. We're going to get to them because it's important about the mistakes. But once I decided multifamily is mine, I want to learn this business. I started investing in mentorships. I met Jake in 2009. I was ready. In 2011, Jake moved down to Knoxville, Tennessee. I followed him as far as this is where we're going to invest, Jake. It took us 18 months to find our very first deal. After that, the second deal was 3 months late, 3 months after that. Before you know it, 5 or 6 years later, we're at almost 1,000 doors. And it was just an amazing ride. But there's a lot of rocky moments. For me, becoming clear on this is what I want. When everyone asks you, what do you want? I was quick on saying, I don't want to be at the restaurant. That's not the answer that you're getting asked, Gino. What do you want? And when I really understood that I just wanted to create some kind of income and some kind of lifestyle for my family, and then ultimately really create an enduring organization and create something that I would be proud of, create a legacy for my kids, and to create a company like Jake and Gino that could create impact for others.
You've changed a lot of family trees, including your own, which is incredible. Gino, what are some key lessons you might have learned from your early days in the restaurant business that maybe now you apply to your real estate investments? Or is there any kind of mindset framework that you worked on from running the small business, running the restaurant, moving forward?
Alex, unfortunately, there are no shortcuts in life. People need to understand that. The one thing that I learned in the restaurant business was hard work pays off ultimately. When you're sitting in Starbucks, you're drinking your latte and you're complaining that you're working hard, look in the kitchen of Starbucks and see that person working in 100-degree temperatures, working 8 hours on their feet, sweating, making $15 an hour. Then your life looks a little bit better. It was a hard job that I had. I loved it. I grew up in it, but I worked on the holidays. I worked on the weekends. I missed a lot of events, and I would not give that up for the world. When I have a problem or I have a difficult situation now, it's not as bad because I've built that muscle on hard work. Persistence is also really important. But what I really learned with having a small business was I had the small business mentality. I didn't have core values. I didn't have a mission statement. I didn't have really a vision for my company. It was just the I'm a mentality. I'm going to do this. I'm going to do that. And ultimately gets burned out. Every time I had a situation at the restaurant, it wasn't my fault. It was the employee's fault. But if you don't have core values for them to follow, if you don't have a mission statement for them to fall back upon, it's really hard to get quality individuals. People will come to work for you for pay, but they'll come to work for you and believe in you if you have core values and if you have a vision statement and a mission statement. And I was lacking that. That's how I say to myself, I said so flippantly, hey, after 5 or 6 years, we had 1,000 units. It's because we had a lot of these things in place. We had systems and cadences of accountability to be able to grow. And that's why I was stuck at that one restaurant for so many years. And that's why I wasn't able to scale. Those two things I would say is really the hard work, the persistence to be able to build a business. You need to invest in systems and you need to invest in becoming clear on your core values.
That's what I tell folks all the time. I do these free 15-minute discovery calls. Basically, a lot of what we talk about, it's like, hey, how can I buy an assisted living home? That's what folks want to talk about. Or how can I buy this? How can I buy that? How can I invest in this? And I say the same thing you said. You have to figure out what your vivid vision is. You have to figure out where is your life going and where do you want your life to be in 3 to 5 years and reverse engineer it back and have those systems in place to help you do that along the way. Doctors absolutely know about how to work hard. We work really hard and we work long hours. So you hit the nail on the head. I think it's so important to have that vision, have those goals planned out, have those KPIs that you're tracking and move forward in order to develop and to grow going further.
Alex, there's another thing I would add to that. This is something that may be hard for some people just to understand it or to grasp or to want to admit. I think we need to humble ourselves. I needed to humble myself back in 2008 and say, God, I don't know everything. I need help. How do I figure this out? I went out and I paid for my tuition. It's interesting that people are willing to pay $300,000, $400,000, $500,000 for a college education, but when they hear somebody's charging $20,000 for a mastermind, they lose their mind. One idea is all you need to recoup that investment. That mentorship that I took in 2008, if I had met Jake in 2009, I would not have known about multifamily. I would not have been able to provide value to Jake. Jake moves down to Knoxville. He doesn't need Gino to partner, because Jake doesn't know anything about multifamily. I'm the one who knew about it. Understanding that even as a doctor, you can be incredibly intelligent in your craft, but you need to humble yourself. Like I said about scaling up, we didn't know how to scale a company. I'd never scaled an organization ever in my life. So when we're at about 500 units, we're stuck. We're like, how do we grow? Let's stop buying deals. We're going to outgrow our infrastructure. We got traction by Gino Wickman. We got scaling up with Vern Harnish's group. We invested a significant amount of money to learn how to do that. We could have been there and said, I'm going to do this, I'm going to do that. Like I said, Ima gets burned out, and Ima has to say to himself, I got to this point. I don't know how I got to it, but thank God, because most of us need to bootstrap in the beginning. But when you get to a certain point, you don't know where to turn. You don't know where to go next. You've never learned these skills. Humble yourself and go look for the help.
I love that. If you don't mind me asking, what does the portfolio look like now? What does Jake and Gino look like now? We hit the beginning working in the restaurant. What does it look like now? How blessed have things been going from there and having the courage to hop in that mastermind and network and get into a community? How much return on investment have you had?
We've been incredibly, I would say, fortunate because we have that long-term mindset. When people were buying deals and flipping out in 18 months, we've continued to hold our assets. Currently, we own 1,700 units. We have no syndications. The majority of it is owned by me, my business partner, Jake, and my other partner, Mike, with maybe a 10 or 15% owned by, we have a lot of employees in our deals. So the vast majority of it is ours. We had 3 syndications. In 18, we did a couple syndications because we ran out of money. We're like, oh crap, those syndications really fill the gap. We're able to buy those syndications with the idea within 3 to 5 years, we're going to exit them. On the front end, you're getting acquisition fees. You're able to scale the portfolio. You're able to continue to build. But on the back end, you're able to extract that equity and put into the next deal. We've been able to refinance out over $25 million of capital in our deals over the last 10 years. And like you said, I'm not driving a Lambo. The money goes back into the next deal. That's what we've been able to do to continue to scale. And currently we have 3 deals on the contract right now. We're closing on a 62 unit end of July. We've got a 67 unit end of August. And we've got a 33 unit October 1st. And these are all deals that are funded by ourselves, me, Jake, once again, my business partner, Mike. We've gotten to the point where we don't need syndication right now. And we'd rather not scale. This is important for everybody. Everyone is infatuated with this. I've got to go big or go home. I've got to scale. No, you don't have to if you don't want to. Read the book, Small Giants by Bo Burlingham. It gave us a lot of clarity. And we said to ourselves, we don't need to be the next investor that owns 20,000 units. That's not us. Our main metric is PPU, profit per unit. And we generate between $200 and $300 profit per unit in our portfolio. That's what we're trying to generate. We're looking for deals that we will be able to buy, put on the contract, reposition, and within 18 months to be able to generate that profit per unit. That's what we're looking for. We don't want to outgrow our infrastructure. As I said, we're vertically integrated, so we manage our own assets. That's another thing. Do you want to go third party where you're able to scale quicker, but you have less control? Or do you want to stay a little bit smaller like we are, able to control it, have a little bit more equity in deals? There is no right or wrong. You can do them both. You can syndicate deals. You can JV deals. You can do some deals with seller financing. There's so many different ways to get into the business. And I think one size fits all is not the right way to do it. And it really is a function of the market cycle. When we started, seller financing was crazy. We did like 3 seller finance deals in the first 3 years. Then for 5 or 6 years, it disappeared because you could fog a mirror and you could sell your property. Now seller financing is back. And all of a sudden, syndications became a rage in 2016 and 17 because of the Jobs Act. And now syndications have slowed down a little bit because it's a little bit tougher to raise capital. It's just part of the market cycle. Learning and understanding all of the different strategies in real estate will make you much more successful.
I think the whole one size fits all, the big thing that folks always talk about is how many doors they have or how many units they have. Oftentimes, I think folks get kind of misled by that because they think like, oh, well, this person has, 1,500 units when really it's like they own 1% of those 1,500 units, which is still impressive, but it's just a number. And you can take like a residential assisted living home, which we were talking about beforehand. Maybe that one residential assisted living home that's cash flowing $10,000 to $15,000 per month once it's stabilized and operating well is all that you need to completely change your life. So it does look completely different. And that ties back to the importance of figuring out what your vision is and what your goals are and what your mission is going forward so that you can figure out how can you hit the goals and the metrics that you want to hit. How did you and Jake get started in multifamily? I know you said you had a good bit of knowledge in the multifamily space and that's what you brought. How did the origin of Jake and Gino get started?
In 2009, I meet him through my brother. He is a real young hustler. He was one of the only pharmaceutical reps that would come into the restaurant. He was prepared. He had all his lunches in order. He was a hard worker. He had same values as I did. At the time, we call it values-based decision-making right now. But at the time, our values really aligned and we both had pain points. He wanted to leave New York. He wanted to leave his job. And I wanted to leave my job. When he moved down to Knoxville, hey, I said, Jake, when you get down there, let's start looking at deals because deals look pretty good down there. And we started looking at deals. Unfortunately, it did take us 18 months to find our first deal. His fiance moved down. He ended up buying a house. That slowed us down. But remember, when you're entering into a partnership with somebody, you better be able to provide value for that person. And I was able to provide a ton of value for Jake. I don't want to say I taught him the business, but he'll tell you he was a W-2 employee. He had that mindset. He knew nothing about investing, but he provided a ton of value for me because he was my boots on the ground. He was able to go to the properties. He was able to negotiate with the brokers. He was able to go to the community banks. When we took the deals down, he was able to property manage. While I was managing from afar, I was the asset manager. He was a property manager. So for anybody looking to partner with somebody else, take a real good look in the mirror and say to yourself, where does my value lie? And am I going to work really hard? Because that's important. You can't let your partner down. You can't make excuses. You need to set expectations on the front end, and you need to really go through those expectations. Memorial Day weekend, everyone's out there partying. Friday afternoon, my business partner is putting a deal on the contract. He's sending a contract out because he knows if that deal goes till Tuesday, someone else is going to see it. So he's not complaining, oh, I got to work this weekend and put a deal in. No, he knows what it takes to feed his family and he does it. And I think that's the power of the partnership. You need to be able to sacrifice for your partner, work hard for that partner. And I think if the partner sees that, they will reciprocate, hopefully.
That was definitely something that I wanted to ask you, which you felt like made a good partnership. I talked to folks about it too. And I'm like, your partnership is similar to a marriage. That's how important it is. I'm sure there's been some challenging times that you guys have had from a partnership perspective. Has there been anything that you've learned along the journey that's been helpful for mitigating difficult conversations that you and Jake have had, or anything like that that you would recommend for folks who are thinking about partnership down the road?
I would just say the difficult conversations are important to have. I mean, don't put them off. Don't make excuses. Number one. I think number two, you need to have a similar mindset as far as we were both all in on multifamily. And remember in 2020, all of a sudden deals start drying up. We're considering going into RV parks, maybe fixing and flipping a couple homes. If your partner is thinking that and you have another idea, that's not going to work for the partnership. You really need to be on the same page. If your partner is a deal junkie and you're looking to hold these assets for long term, that partnership is not going to work for the long term. It may work for one or two deals. It's really good to understand that and to learn that lesson early on. Jake and I both started seeing the power of holding these assets. Buying a property for $45,000 a unit in 2016 and holding it today, and it's worth now $170,000 a unit, maybe more. There's so much power in that. You do one or two of those deals, they are completely life-changing. Understanding what your values are, understanding what your partner's values are, and trying to have the same vision. Now, this is if you want to have a partnership that's long-term. If you're looking for one-off deals, that's a different story. You can partner up with somebody, do a JV. That's a one-off deal. But if you're looking to build an organization, and if you're getting into multifamily or if you're getting into self-storage and you want to build a bigger entity, it's going to be difficult to do it on your own because there's so many responsibilities. You've got capital raising, you've got deal underwriting, you've got employees to work with, you've got content to create. If you're going to do that all by yourself, once again, IMA gets burned out and IMA's not good at everything. Jake's really good at some things and I'm really good at other things. Whatever we suck at, we find someone to help us out with. That's what a partnership does. And let me tell you, Alex, the last thing, when you're having a tough day and you're down and you're getting kicked in the stomach, I can always pick up the phone and say, hey, bro, rough day. What do you suggest? And he knows exactly what I'm going through because he's going through the same thing. Listen, I love talking with my wife and discussing strategy. Sometimes she checks out. She doesn't care about real estate. So some of those conversations I can't have with her.
I have two amazing partners, Luke and Charlie. A good partnership just completely changes the game. We've all grown so much more as husbands, as fathers, and business owners together than we probably ever would have if we were trying to do this on our own. Folks often think about like, oh man, now if I partner with someone, then I'm splitting ownership 50-50 and that's 50% less that I'm going to get. And that's the problem. We've grown, like I said, so much faster than we ever could have by ourselves. That far exceeds the equity that we've given up in our business. It's silly to even think about at this point. I love that. Thanks for sharing that, Gino.
It's scarcity mindset. That really rears its ugly head when you're saying to yourself, I've got this pie and I've got to split this pie. But how many deals can you do by yourself? I can't close 3 deals in a row in the next 3 months by myself. That's not feasibly possible for me to do it because I've got another business I'm running. But with him running that entity and I'm running this entity, it makes it a lot easier. Plus, I have funds. He has funds. We put them together. We can buy more and we can actually scale and diversify a lot more. If he's by himself, it's a lot more challenging to do that. So you can look at it as, hey, I'm getting less equity in each deal, but you will be doing more deals and you'll be able to have more experience and you'll be able to say, I want to do this part of the business where I'm really good at, and Jay can do that part of the business.
That's the beauty of partnerships with complementary but different skill sets. It's super important for that. I heard a quote from my buddy that I really like, and he says that information's not the answer, implementation is. And I know you guys have a fantastic community as well. What are your kind of thoughts in regards to that statement?
For me, getting online, watching a video, it's great, but what's the next step? And that's the problem that I was having with scaling a company. I just learned a video on creating habits. Okay, what's the next step? How do I implement that? I didn't have the answer. I had to find somebody who did. Knowledge is everywhere. You can find knowledge anywhere. The implementation of that knowledge to me is key. And that's often lost on people and thinking that they can go out and do it themselves. It's very challenging to do this business yourself. There's only a couple of things that are different in multifamily than they are in residential or the niches, but those things change the world and make it a lot more difficult in our business than, let's say, residential. If you don't learn those, you're just going to continue to spin your wheels. And unfortunately, after a couple of months, you're going to get frustrated and you're going to say, yeah, they were right. Real estate's too risky. Multifamily's too hard. I don't have the money. I don't have the time. They'll make all the excuses when in reality, it's never about the time.
In those months that you're spinning your wheels, if you would have just taken that next step, spent a couple $1,000s to join an incredible network or mastermind or community that would have gotten you started way sooner, it would have just completely changed your life. And folks get really wrapped up in that, as you mentioned before, of like, hey, I don't want to spend $20,000 for a mastermind program, but I'll spend $300,000 to go to school. Or for some folks I know have $500,000 in debt between college and med school. Think about that investment that you made and think about you need to invest in yourself from a financial freedom perspective going forward, and surrounding yourself with the right people like we did in our residency training makes all the difference. It's this see one, do one, teach one mentality that's really important in real estate as well as medicine. I know that you have been working on Passive Investor Pro. Do you mind kind of talking a little bit more about that? A lot of docs from time constraints, work constraints, passive investing is probably a better opportunity for them to get good returns and still kind of balance life. What do you think about that? What's Passive Investor Pro for folks who are interested in knowing more?
Alex, I've been on Bigger Pockets the better part of 8 or 9 years. I love going through their threads and I love watching and reading what people post. And over the last couple of months, we were reading these posts from limited partners bashing general partners. Oh, my distributions have stopped. I've got capital calls. And listen, they should be angry. But at the same time, no one put a gun to their head and told them to invest. When money's free and money is cheap, we tend to do stupid things. And I'm not immune to that. In 2005, my very first passive investment, a gentleman named Maserati Mike pulls up into my parking lot, driving a nice Maserati, by the nice gold Maserati, I'll never forget, beautiful car. And Maserati Mike decided to pitch me a deal. Now, he was referred by a friend, but I didn't know how to invest in real estate. This is a mobile home park. And I gave Maserati Mike $172,000 over 2 or 3 deals. All of a sudden, after 6 months, the deal stopped cash flowing. And after a year, Maserati Mike decided not to call me back. I went through this withdrawal period of blaming Maserati Mike, getting mad at him. It's his fault. He sucks. And you know what? Guess what? It is right. He did suck. He was a criminal. But in the same token, it was my fault for not understanding how to invest in multifamily, not in mobile home parks or in real estate. Just having money and saying, here, I need to find a deal. I hate that when people say I need to find a deal because I know what that means. It means I'm desperate. I've got money. I've got an edge. I've got to do something with this money. The first thing you need to do as a passive investor, this is why I created Passive Investor Pro, because I want strong LPs. Because if we have strong limited partners, when GPs bring a deal, and this deal stinks, they're not going to get funded by these LPs. And all of a sudden, the deal doesn't get funded, prices come down. Prices come down. That means Jake and Gino and Alex have more opportunities to find better deals. If we have stronger LPs, it'll hold the GPs to account. If the general partners or the sponsor of deals use this framework, they'll be able to present their opportunity and make sure that they align with limited partners. The three-step framework is pretty simple. The first part of this framework is the sponsor. Think of the sponsor being a jockey on a horse. What do passive investors do? The first thing they say is, I want a deal. The first thing that they should really be looking at is, who are the Maserati Mikes of the world? Are you looking at that Maserati Mike? Now, we can't go through what you're supposed to be looking at in terms of what a Maserati Mike should have, but have they done a deal before? Do they have any skin in the game? Maserati Mike didn't put any money in his deal. So when the deal went bad, Maserati Mike got in his car and drove away. That was my fault. I didn't even think of that. What was his track record? What was the way he communicated with me? How is that sponsor? In this past market cycle, people have made a ton of money on real estate just by cap rates compressing. Even if your NOI stays flat, your cap rates are going down, you're still going to make money and sell out of a deal. Ask a sponsor, what has your NOI growth been over the last 3 or 4 years? It's an interesting question because some of them may not even know what you're talking about. And if they don't, that's your cue to run away. But you'd like to hear positive NOI growth over the last 3 or 4 years. That's something where you're looking at the sponsor. That's the first part of the framework. If I looked at Maserati Mike through that lens, I would not have given Maserati Mike 10 cents, but I didn't. The second one, Alex, is really important also. It's the saddle. You have the jockey. He's sitting on the saddle. That saddle denotes the alignment of interests. Are your interests aligned with the sponsor? Most investors don't even think about why they're investing money in real estate. Is it your last $50,000 and the sponsor's saying to you, man, real estate's great, not risky, you'll never lose your money? Your interests aren't aligned because a sponsor in good faith should never take a person's last dollar or money that's earmarked for something that's really important because there is risk in real estate. They shouldn't be investing in any asset if that's the case, but especially if you're a responsible sponsor, you should not be pitching a person if that's their last dollar they're putting into the deal. How are the fees? Are the sponsors just doing these deals to get fees? That's really, really important. Does the sponsor have any skin in the game? That's an important question. Are interests aligned? If the deal does better, does the sponsor make more money as well? Or is it just he's going to make a flat fee and it doesn't really matter how that deal, presents itself? As far as time, if you're looking to get your money back in 2 years and the sponsor says, hey, it's a 5 to 7 year deal, are your interests aligned? So just make sure as a doctor or as a passive investor, understand what your goals are in real estate. Understand that you want to align your interests with the sponsor's interests. Once they align and work well, that's going to be awesome for whatever opportunity there is. And this is the third part of the framework, which is the horse, which is the deal itself. Now that you've got the sponsor, you love Alex. I love his model. He's making 10 grand a month on these assisted livings. I like the long-term aspect of it. I like the way he can scale. My interests are aligned with his. He's not killing me on fees. I can understand the buy and hold model. I like it. Our interests aligned. Sponsor's great. Now let's look at the deal. The deal should be looked at through the lens of what we call our 3-step framework in multifamily, which is buy right, manage right, and finance right. So now that you've taken care of the passive part, let's learn how to invest in real estate using that 3-step framework. And that, wish we could spend time on that. If you want more information on the 3-step framework, just email me, Gino@JakeandGino.com, and I'll send you a copy of Wheelbarrow Profits. But I don't think that people understand that there's some work to do on the front end. Learn the business on the front end. Spend some time on the front end, how to invest, because becoming a passive investor can be really powerful because you can continue to do what you love, and that excess capital that's getting thrown off by your businesses or by your profession can be invested passively into real estate. But you have to understand all on how to choose the sponsors. You have to understand on what deals make sense for you. Once you understand that, it's basically a rinse and repeat. That's the power of learning any framework. Once you've learned the framework and you've done it a couple times, it's pretty easy.
I love that. Sponsor saddle horse. So good. And something that's super important is that deal is last. You're vetting the sponsor, you're vetting the opportunity. And that's the important piece too, is it's an opportunity. There's tons of opportunities out there.
Right.
You have to figure out, does this align with your interest? You mentioned fees, and a lot of folks listening to this podcast are just getting started. What are some fees that folks should look out for in terms of if they're looking to invest in a syndication? What are some fees that they should ask about or want to know in regards to that syndication or deal?
In a syndication, Most of the time, the sponsors put very little capital into the deal. But what they do is they put the deal together. They have expertise. They have team members. If you're a passive investor, make sure you ask the sponsor, who are your team members? Can I see who your syndication attorney is? Who's your CPA? Who's your cost segregation specialist? Are you using third-party property management? Can I see them as well? And oh, by the way, who are all of the partners on the syndication? Because I want to be able to vet and speak to every single one of them because they're material in this deal. But the general partners, the sponsors, they're signing on the debt. They're taking a lot of risk and they're taking a lot of time. And it's an active business. They need to be compensated for that. So the biggest fee that you find is an acquisition fee. I mean, it can go anywhere from 1% to 5%, depending on the dollar amount. Typically, it's between 2% and 3%. So if you're doing, let's say, a $10 million deal, 3% of that $10 million would be a $300,000 fee. The passive investors will pay a total of $300,000 to get into that deal. Just common standard. The other one would be an asset management fee, not property management fees, because property management fees are different. Asset management fees, you have an asset manager who is managing that asset. It's typically 1% of whether it's revenue or equity raised. Either one, it really depends. Other fees, you're going to have construction management fees possibly when they're running these deals and they have to do construction on it. They have to manage the assets. They're going to continue to put that kind of fee in there. Some do, some don't. We never charged a construction management fee. We were doing a lot of this stuff in-house. You have something called a disposition fee or a refinance fee. If the asset is sold, they're going to be getting paid an X amount. Maybe it's 0.5%. Or if they refinance, they're going to get paid a fee as well. Fees aren't bad in and of itself. Just make sure that their fees are in alignment with what's going on in the market. If you're listening to this, I would go on there and I would Google multifamily syndicators. I would Google self-storage syndicators. Google as many syndicator groups out there as possible. Start opting into their lists and start getting their offering memorandums in and see what's going on. See what we call the preferred rate of return, that rate that you get as a limited partner on the front end that's guaranteed to you. Right now, between 6 and 8% is what people are giving. What's the co-promote? The split between what the general partner gets and what the limited partners get. Typically, right now, it's a 70-30 split or an 80-20 split, but it depends upon the group. If I'm a kick-ass group and I've been delivering amazing returns, I may want a 60-40. If I can give you a 25 IRR, that's the idea. Don't get focused just on the splits or just on the internal rate of return or just on the hurdle rate. It really has to work for you as an investor. So Google every syndicator out there that you possibly can, get on their lists, start getting their offering memorandums, and start reading through them. Start reading through what is going on in the market, and then you'll start to learn about all the different groups and all the different opportunities out there, and then choose a niche. What I love about being a passive investor, you can invest in different markets. You can invest in different asset classes. You can invest in different operators. You can invest in different niches. I want multifamily here. I want self-storage here. If you're starting early on, I would focus on one niche. Listen, I would focus on multifamily, to be honest. That's just my passion, my love. But if you like RV parks or you've had some experience with them, focus on RV parks for your first 1 or 2 passive investments, because I want you to learn that business as if you're running it yourself. And if you have to underwrite that deal and you can understand it from that perspective, it's always better to get more experience with one asset class. But it's really an amazing thing if you think about it. I can invest with Alex in assisted living. I can go to Jake and Gino in multifamily in Tennessee. I love self-storage in Dallas, Texas, short-term rentals in St. Augustine, Florida. I mean, the sky is the limit with the opportunity and diversification you can have.
Thanks so much for that. I mean, this last 15 minutes is just a masterclass in passive investing. How can folks, if they want to know more about Passive Investor Pro or get involved in that, how can they get more information in regards to that?
That's a good question. I mean, right now, we have it on our website at Jake and Gino, but if you want more information, just email me, gino@jakeandgino.com. Full transparency, we just launched a program about a week or 2 ago. It's a yearly program. What I wanted with this is I wanted to create an online platform. I wanted to be able to give the Jake and Gino community so people can come out and they can come out to all the Jake and Gino events. But more importantly, I wanted one-on-one coaching. We've got some amazing coaches. When you're a passive investor, you're looking at a deal, you're not sure what you're looking at, you pick up the phone and call the coach and say, hey, coach, how does this deal look? walk me through what this looks like. Is this a deal or not a deal? The coach is not going to tell you it's a deal or not. He's going to tell you, look at the debt service coverage ratio. Does that look good to you? Why are rents growing at 15% a year? Does that look good to you? Why are they raising more capital? That look good to you? And giving it back to you as cash flow. These are just instances where if you're just beginning, you may not be able to catch it. That's why to me, coaching was revolutionary to me, because when I had these questions, I could ask somebody who was an expert. And I have so many people that join Jake and Gino and say, if I had learned this stuff before I had invested passively, I never would have done that deal. That's the tragedy, that we don't know. And we're just have this money. I always say a person with money meets a person with experience. The person with experience gets the money, and the person with the money gets the experience. That's what I'm trying to avoid with Passive Investor Pro, because I don't want these crappy deals to be funded, because if they get funded, they hurt the whole community. They hurt the whole multifamily. And ultimately, do you know who really gets hurt, which no one really talks about? It's the residents that get hurt. It's the community of residents. They get crappy service. They've got high rents and they get a ton of turnover. There's the employees in the industry get hurt. And ultimately, the investors, the limited partners get hurt. So that's what I'm trying to avoid. If we can have more stability, it'll return back to a place of normalcy. All of a sudden, cap rates will start to stabilize.
I know we mentioned earlier how we have a 3-week-old, and I know you have 6 kiddos. How do you balance your professional ambitions with your personal life? Being a father of 6, being married, how do you balance all of that? If you can, have you figured out any tips or tricks along the way?
It's a challenging thing to do. I mean, I have to say no to a lot of opportunities. I unfortunately can't hang out on Sunday and watch 8 hours of football with my friends. I can't go golfing on Sunday morning and hang out. Especially when I was at the restaurant, it was challenging. I was working on the weekends and I was off, and I had to really make those tough decisions. Am I going to be there, spend more time with my family, or I need more me time? I sacrificed a lot. Now that I've gotten into the business, I was fortunate that they were able to come and work with me at the restaurant. And now that I have Jake and Gino, they're able to come to the events. We talk about business all the time. They're always around the dinner table. We're always talking about money. I continue to write books. They're in my books as well. For me, it's really blending the whole thing together. People have this fear about talking about money with their kids. I want my kids to know the struggles that I've had with money. I want my kids to be part of our budgeting process. I want my kids to know that, hey, we just bought a home. This is how much we're spending on the home. This is why we're not doing this project, but we're doing that project. Just being open and transparent with them is so important when it comes to money. And for me, I got 6 kids. I try to spend a little bit of time each day with all 6 of them. Is it hard? Absolutely. And I just think it's great. It's the best thing in the world to be a parent, to be a father. For me, I look back, one of the biggest regrets that I have of being a parent is not learning how to say sorry sooner to my kids. If there's one thing that I would recommend to parents, it can be challenging. I mean, you had a rough day, you come home, you're pissed off, you're angry, you yell at them, and you know you made a mistake. Being transparent and being vulnerable to your kids goes a long way, because it'll make them understand that, hey, you're human, you make mistakes, and when they get older, hopefully they can have the grace in their relationships to do the same.
Getting your family involved in the financial discussions, especially physicians for the most part, as we talked about earlier, sometimes we get concerned, or at least I know I get concerned thinking about my kids' future and kind of explaining, hey, this is the value of the dollar and this is how to have a good financial foundation going forward. And I'm sure those conversations around the dinner table have been so informative to your family and to your kids to understand, like, Dad worked really hard at the restaurant and now everything that he's built with Jake and Gino, and that's probably been so influential to them. Do you have any tips or tricks to folks with young kids like myself about how to kind of form that financial framework with them, or how to talk about money more so from a perspective of them appreciating it? There's
a couple things that I can say. The first thing is, don't rush it. I think most of us, especially myself, I got excited about talking about money. And I'm like my 7-year-old, I'm going to save the money for you. I'm going to take it from you. I'm going to put it in the bank. Well, to them, that's a form of punishment. They don't understand it. It's all like gamifying it and making it fun. I'm actually writing a book right now called Happy Money, Happy Family, Happy Legacy. I've made a ton of mistakes with money. And when I interviewed a gentleman named Ken Honda, if you want to read a great book on money, Ken Honda wrote the book Happy Money. And he challenged me. I interviewed him. He said, hey, you should write a book on happy money, happy family, happy properties. But I wanted to write one on not just properties, but on legacy. because what we're doing, me and you right now, you're recording this podcast will become part of your legacy. Your kids hopefully one day will click on YouTube and will see you talking. All the stuff that you're learning, all of the knowledge and the values and the experience that you have, hopefully you'll imbue that and that will become part of their legacy. You're not just turning over money to your kids. You're turning over your experiences and the values that you have. Hopefully when they get to be of age, that you'll have imparted that wisdom and they'll be able to understand what a budget looks like. It's funny. My son is 22 years old. And he has 9 K1s this year. I didn't have 9 K1s until I was 43 years old. He's 22 and they're all his. I mean, it's just mind blowing because he's put away $5,000 in one of my deals back when he was 15 years old and now he's 22 years old. And he's understood not to take the money out, to continue to refi and to roll deals and to continue to grow and not take the money out from not buying an amplifier back in 2015 and putting that money into a deal. That's the power. So he's learned that lesson. We are stewards of our kids, choices. That's the reality. If I had told him, Mike, don't worry about it. Go buy the amp. You already have 2, but what's another amp? I was an adult. I had to be the adult and I had to teach him. And I think it's great. Sometimes you want to be your kids' friends. Sometimes you need to tell your kids what to do and it's okay. And then one day when he's 22 years old, he'll wake up and go, Dad, that was great. You've got a deal closing this month. I've got 30 grand that I can put into it. I don't have any money for the next deal. How do I get money for the next deal, Dad? I'm like, Mike, you've got a business. What about a line of credit? Man, that's a good idea, Dad. So all of these little lessons, he's asking me for seller financing. How many 22-year-olds do you know about seller finance? He wants to seller finance me. I'm like, Mike, you're actually liquidating me, Mike. You're killing my equity. I won't let you do that. But just the idea, like to be able to think about these kinds of things. And that is coming from financial intelligence that I've been able to impart upon them over the last 3 to 4 years. Every time we do a deal, I go over the deal with them. I sit down with them. And it's very challenging because early on, like I said, Alex, it was hard for me because I wanted them to sit down and I wanted to learn about budgeting and I want to learn about that. It comes slowly. If you make it fun, you make it interesting, and you let them get excited. Some kids don't really care about it, but they need to learn certain skills as far as budgeting goes and as far as worrying about money later on. They need to understand, like you said, the value of money, where it comes from. But just having that open conversation and being transparent with what you're doing with your money.
Congrats to your son on crushing it and getting the education that kids should have in school and are not getting. That's fantastic. I love that, Gino. Well, I want to be respectful of your time. I could talk to you forever. I know you've authored multiple books. You mentioned Wheelbarrow Profits. You mentioned the book that you're working on, Happy Money. And you have another book, The Honeybee, correct?
Yes. The Honeybee is a book based on complementary streams of revenue. If you're at the point where you've grown your practice, career, business, investments, very similar to what Alex is doing right now. He's got a facility right now, assisted living. So from assisted living, all of a sudden he's creating another stream of revenue with this podcast, with a mastermind group. If he wants to, he can create a property management company where he's managing these assets. He can create an asset management company. He can start creating a syndication company. But you'll have to start with that first one, but the sky's the limit. Don't focus on the complementary streams of revenue. Start the business first. Start focusing on buying 1, 2 deals. And then all of a sudden you realize that you don't have to own 600 deals to make a ton of money in real estate. If you have a smaller amount of assets, but you're able to control them and you're able to build little streams of revenue off of each one of them.
How can folks reach out to you if they want to connect with you, know more, any social media links or anything like that you'd like folks to follow?
Yeah, we're on Instagram at Jake and Gino, and just go to the website, jakeandgino.com. You'll see the podcast. You'll see the books there. You'll see the education programs. And once again, if you want to reach out to Gino at jakeandgino.com.
I really appreciate your time. I loved this episode, getting to talk about all kinds of things that are important in life, such as family, goals, vision, and then, of course, real estate, which we love as well. So thank you so much for coming on the Physicians and Properties podcast today. Hey, real quick, if you're still listening to this, I'm assuming you got value from it. So I need your help specifically. My 2-year vision with this podcast is to help 100,000 physicians learn how investing in real estate can give you the freedom to practice medicine and live life how you want. There are 2 main ways that a podcast grows. One is through ratings and reviews, and the other is word of mouth. If you can please leave me a 5-star rating and review on Apple Podcasts and Spotify, as well as send this to 1 to 2 friends that you think would get value from it, we can reach the physicians that we want to reach. Thanks in advance, and talk to you on the next episode. Please note that the information shared on this podcast is for informational purposes only and should not be considered financial or medical advice. The views expressed on this podcast are those of the host and the guest and do not necessarily reflect the views of the Department of Defense or the United States Air Force.